So there's been a lot of hype about this latest budget from the government because it's going to be an election year, right? So this is going to be the one where if they really want to convince us to vote for the Conservative Party, potentially there could be a huge number of maybe giveaways, basically telling us all these great things that they would be doing for our finances. So we, in return, decide to keep them in power rather than going for an alternative. And there were a lot of things which were kind of announced or rumoured in the previous, well, not just the last few days, but the last few weeks and even months. So there was kind of expectation that there might be something extra, something big that might come, even bigger than things that were rumoured, to be part of that kind of, say, rabbit out of a hat, don't they? Kind of this big surprise to really convince you. Well, that didn't happen. If you've been following the news, I say, over the last few days and weeks, then pretty much everything that was in there you already knew about. But some of the things that were rumoured weren't in there, and we will talk about a big one there as well when it comes to lifetime ISAs, because I know a lot of you will be looking out for that. But anyway, but what has been announced, this is what's really important. So I'll take you through the key announcements that relate to us as consumers, as normal people, and what that might mean for you. The big one, and this is big, it is still a big announcement that's going to cost a lot of money, is a tax cut, and this is to national insurance. Now, hang on a minute, you might be thinking, this isn't new news, this has already happened. This is another one. So in the autumn statement last year, it was announced that from January, so a few months ago, we would see a 2% cut in the national insurance contributions that we make as employees. When we get a salary, these are the kind of contributions that we make. And that was going to be a cut from 12% to 10%. Well, that is being doubled. From April the 6th, 2024, so from the new financial year, that will be now 8% of national insurance. So 2 cuts in a row, effectively, in a short space of time. And that will mean, for the vast majority of people, you bring back more money on your earnings. Not quite as simple as that. We'll come back to that in a minute. But so that's the main thing to know about there. That is for people who get salaries. If you are self-employed, then there is also going to be a cut from 8% to 6% on Class 4 national insurance contributions. That was already a 1% cut we've already seen there. So this is again another cut for if you're self-employed as well. And we've already knew, again, back in that autumn statement last year, it was announced that Class 2 national insurance contributions would be scrapped from April. So all in, either we've already had some tax cuts from NI at the start of this year, and we'll see some more, or we'll see even more if you're self-employed from April this year. So it sounds good, doesn't it? So a couple of things here. Why national insurance cuts rather than income tax cuts? Because it's cheaper is the main thing, really. If you cut income tax, you are reducing the tax that's paid on pretty much every type of income. But national insurance only, as I said, only counts towards your salary. Whether you're employed or self-employed, it is your salary that you pay that this contributes to. So pensioners will not see the benefit of this tax cut. People who receive an income from savings or maybe from property, again, they will not see the benefit of this, just on salaries. Although conversely, you could argue that because income tax is done separately in Scotland, if they'd gone down the route of doing an income tax cut, then the Scottish people, if the Scottish government didn't decide to do it as well, they would have missed out. Whereas this one, national insurance, is England, Scotland, Wales and Northern Ireland. We're all going to be benefiting from this cut. So that's the big reason why they probably did this rather than the other one, is because it's cheaper. The Conservative government also say they want to be rewarding people and encouraging people back to work. So they want people to be wanting to earn money from their salaries rather than other forms of income. That's what they would also say there as well. Now, the average saving here for the employed for this extra cut is going to be around 450 quid, but that will vary depending on how much you earn. Now, ahead of this, because this one had been leaked, I got a number of press releases from people giving examples of what that tax cut could be worth in our pockets from the beginning of April. And this one here is from Interactive Investor that I'm going to share with you. So if you currently earn £20,000 from April the 6th onwards, over that whole tax year, you'll be better off by £149 in terms of you'll pay less tax. That's an important distinction there. £149 less tax. If we double that to 40,000, then that tax return, the amount you'll get is 5,400. Crazy. Is £549. And if we go up even higher, £60,000, £754 less tax you'll be paying. In fact, because this national insurance is only really paid, or this level of national insurance is only paid on earnings between 12,571 and 50,270. That anyone basically, as long as if you earn more than £50,270, you're going to be better off by that £754. Now, when I say better off, there is an important distinction here, because remember, these tax cuts are tax cuts, right? They're good news. But at the same time, we are experiencing what's called fiscal drag. And fiscal drag is where the tax bands, the income tax bands, are frozen. And these have been frozen for a good few years now. They can remain frozen until 2028. And when they're frozen, it basically means every time you get a pay rise, you get pushed up potentially into or closer to or past another tax bracket, which means you pay more tax. And that means that with one hand, we're getting these tax cuts, but we're still getting some pay more tax with the other hand. Now, the Resolution Foundation have said that most people with this second national insurance cut, most people will be better off despite that, with a net gain. So they'll take this cut over here, they pay more tax over here, but they'll pay less tax over here. Most people will be getting a gain here. However, it is the poorest people, the people who are the lowest earners, where that doesn't happen. They will actually be benefiting far less from this, and net, they will be paying more tax overall. So that's important to remember here. Now, this is a big measure. This is going to cost a lot of money. Again, not as much as an income tax cut would have cost, but it's still going to cost a lot of money. Now, there are some measures I'll talk about in a minute which have been announced, which should generate some income to cover this. But there is still a lot of, from different sort of groups, whether political or non-political, people saying that, is that really going to be enough to cover these tax cuts that have been announced? Is that really going to cover the spending? So what we've got to bear in mind here is that, yes, we might have a bit more back in our pockets over the next year because of this, but ultimately there could well be, and there will have to be, some cuts to the vast majority of public spending. Now, some areas have been ring-fenced, such as NHS spending, so they won't go down, but other areas, that spending could go down. They're already really stretched. So there will be a compromise to this. It's not just all win-win-win. We will find we're pushed out and we're missing out elsewhere as a result of that. And of course, further down the line, there could be other tax cuts needed to contribute to increase spending in those other areas where this has been sort of taken money away from those areas. But we'll come back to some of the tax cuts that have been announced. Tax increases that have been announced. They won't affect many of us, so I'll do that later on. What else is going on? So let's talk about savings and investments next, because this is, again, some stuff that we've kind of known about. We've got a bit more information, not a huge amount more information, something we didn't know about, and something which we were hoping to happen didn't happen. Let's start with the brand new thing, which was a surprise, not a huge surprise, but surprise all the same. A British savings bond will launch from April. This will be a 3-year bond provided by NSNI. Now, until we know what the rate is, and I guess we probably won't know that until the end of this month, or even when it is launched in April, we won't know whether it's worth it or not. The current Best Buy rate is 4.65% for a 3-year fix. So it would have to be paying the same as that pretty much. Or because it is from NSNI, there is the potential, though not the guarantee, that the amount that the money is protected by could be much higher than the normal financial services compensation scheme level of £85,000. But again, when we had the green saving bonds, they didn't have a higher level than that. So will remain to be seen whether that will be a benefit there or not. Obviously, as soon as we do know the rate for that, I'll let you know either here or over at becleverwithyourcash.com/savings, where we update the top savings accounts. Myself and the team are doing that every single day. Now, there's going to be another new way for saving, although technically here it's investments, because there is going to be a new £5,000 ISA allowance that goes on top of the existing £20,000 allowance, purely for investing in UK stocks and shares, in UK assets. Now, this one is not going to launch straight away. In fact, it's going to go for consultations. I would imagine the earliest we'll see it will be April 2025. You never know, it could come out earlier than that. This will be, again, on top of. So we'll have the 20,000 ISA allowance, which is not changing at all. And then if you wish to also invest in those UK assets, you can get that extra £5,000 allowance. So this is only really going to be helping people with lots of money and encourage them to invest more of it. It doesn't help everyone else with their savings and investments. And also something that's not going to help us is there was nothing announced about lifetime ISAs. There have been some really strong rumours that we would see two things happen here. One, that with the scrapping of that penalty, effectively 6.25% less you get out if you withdrew money for any reason other than buying your first home or retirement. We were hoping that was going to happen. That hasn't not been announced. Plus, we also hope we'll see an increase in the threshold for the value of a property you could use it on. That stays at £450,000. Now, of course, things can be announced in the interim, but because it's an election year, it's very unlikely we'll get another kind of fiscal statement, as they call it, before that happens. It's not impossible. It could happen, but it's unlikely. So really, I think whether this rules come into play or not will depend on the results of the election. But again, you'd hope we'd see something around lifetime ISAs at some point. So that's a big disappointment there. Now, the other big news here, again, it had been kind of a lot of pressure on this sort of consulting and campaigning, is around child benefit. Now, if you've got kids already, you'll know that there is a threshold. This is called the high income child benefit charge. And this comes into play that if one parent earns more than £50,000, then the amount of child benefit you get will start decreasing until you earn £60,000, and above £60,000, then that will disappear. However, if you had two parents both earning £49,000, for example, then that doesn't happen at all. So as a household, you're earning much more money, but you are going to be getting the full child benefit, whereas single parent households, or one where one's a high earner, they could be seeing it reduced or not even get it at all. Now, this is going to change. It's not going to happen straight away, but from April 2026, subject to consultation about exactly how to implement this, this will become an overall household-based income. So that would mean that you can, again, earn more than that, again, split across you and your partner. But because it's going to be a while before that comes into play, there is going to be another change from the 6th of April this year. That £50,000 limit before that high income charge comes into play would increase to £60,000. So if you earn 60k or under, you and your partner, then you're fine, not going to be affected. And then if you earn between 60 and then £80,000, so they're going to be double that kind of period there, you're still going to see it sort of taper down. So effectively, that's a big change in the short term for people with child benefit. What else we got for you? As ever with these budgets, there is a lot of news about taxes that don't go up, and we've got that repeated here with fuel duty. Again, that has been frozen for like the umpteenth time in a year. They never increase this. And also a 5p cut in the duty, which was a temporary one introduced in 2022. It was frozen last year. It's been frozen again for another year. So yes, petrol prices could still increase at the pumps if the price of petrol itself goes up. That tax level, that tax threshold, that is not changing. There's also going to be a freeze on alcohol duty. And this one is specifically to bars, restaurants, pubs, nightclubs, places like that, in order to try and make it a little bit cheaper for us. Again, doesn't stop drinks getting more expensive. It just means that the duty won't be a reason for them going up. There will be a new tax, though, for vaping. This is going to come in from October 2026, and this will be on top of the existing VAT. So it's trying to make it more in line with the tax we already have on tobacco, and there will also be a one-off hike in tobacco duty at the same time as that vaping tax when it comes into play. So there's a while yet before that happens, but that will obviously impact you potentially quite a lot if you are someone who vapes at the moment. A few more tax things to talk about here. Now, there are some changes to property, but again, this is not going to relate to too many of us, these property tax changes, because most of us either haven't got a home, or if we have, we've only got one. But some things to let you know about here. So one of them is a capital gains tax allowance is going to be reduced for second homes. So it's not a tax increase, it's a tax cut, sorry. At the moment, if you're a high rate taxpayer and if you sell a home, there's a good chance that the profit you make on that property would push you into that bracket anyway. There is currently a 28% level on capital gains tax. That's what you're paying on the profit on your second home. That will be reduced to 24%. The idea here, the thinking here is that actually, if it's lower, more people will sell their second home, so actually they generate more income. Now, if you are a basic rate taxpayer, even when that gain is taken into account, that is going to remain at the lower rate of 18%. That is not going to be reduced as well. That will stay where it is. Obviously, those rates are higher than the normal capital gains brackets. And obviously, remember the capital gains tax allowances, the tax-free allowances, they are going to be reduced from April. They're going to halve again. They were £12,300 12 months ago. They reduced in April last year to £6,000, and then they dropped down to £3,000. But that's not changed. That hasn't changed at all. Another, for people have more than one property, something called the multiple dwelling allowance. If you buy more than one property at the same time, at the moment, it's reduced the stamp duty paid. Well, that's going to be scrapped. So if you are lucky enough to be buying more than one home at the same time, then you will be paying more in stamp duty. And also the holiday let loophole. This is going to be closed. So at the moment, if you have a second property, or money properties and you let them for short-term holiday lets rather than to long-term renters, there are some kind of little benefits you get in terms of tax. So you can knock your mortgage interest off the income that comes in. So that again can sort of reduce how much tax you would pay. You can access tax relief when you sell, some tax relief on purchases, maybe some sort of furnishes, things like that. Again, that is this furnished holiday let allowance will be scrapped from April 2025. Around 127,000 properties will be impacted on that. Another benefit of this potentially, who knows what happens is if some of those people decide it's no longer worth having those short-term holiday lets and they don't want to do long-term lets, they might actually start selling those properties and put more properties on the market, which could be good for people looking to buy a first home. But of course, these things don't always work out, do they? So that is when it comes to properties. Some other sort of tax news to share with you. There is going to be an increase for those who fly in non-economy class seats when they go abroad. Economy ones will go up by inflation in 2025, but all the other levels will be inflation plus a to be decided extra on top. And the idea here is obviously to make some money, but also to sort of kind of increase that difference between economy and those other classes. And that's business, first class and premium economy. That will be in that mix as well. Energy tax windfall. Again, this is probably good news for in terms of generating income, the profits made by energy firms. Again, that was a tax that was introduced in 2022. It's already been extended once to 2028. This is going to be extended for another year. So we're now ending 2029. We're going to bring more money in from the profits that the energy companies are making. And again, this is one that I don't imagine many of you watching or listening to this right now are going to be impacted, but you might be. Non-DOMs. Non-DOMs are people who are UK residents, but for whatever reason, their tax is registered elsewhere. So income they make outside the UK, they don't pay tax on it here. That is going to be scrapped. And this is going to be done in stages. So if you are currently a non-DOM here in the UK, it will be staggered introduction of this. If you are from April 2025, if you're a new resident, you'll have 4 years where this doesn't apply, but then obviously it will be introduced after that. Again, these are all about generating more income. What I would say about a number of these things is they are tax increases that are not going to be hitting most of us. From that point of view, that is a good thing. Whether it's enough to cover that national insurance cut, as I said, that remains to be seen. Quick one here on businesses. This is an interesting one for us. I don't think it's going to have a massive impact, but the VAT threshold is going to increase. So at the moment, if you're a small business and you generate more than £85,000 income on a kind of rolling 12-month basis, so every month you'll be checking this, you have to register for VAT. And when you register for VAT, it means you'll have to increase the prices you charge to your customers. That is going to increase, not by a huge amount. It's going to increase to £90,000. Now, I guess that could mean that some companies can deregister for VAT, and that means they might decide to pass on those savings to us. I would imagine that actually because of rising costs elsewhere, if you've been able to deregister for VAT, then you might not pass those costs back. You might just sort of keep the prices as they are because they've already gone up, but you never know. And I'm sure a lot of places that were pushed up, inflation has probably pushed up just generally their costs anyway, so they kind of probably need already, and what they need to charge people needs to go up anyway, which means their incomes are higher, which means they are probably going to stay in that kind of threshold. But that's something interesting to note there as well. A couple more things to talk about here, and this really relates to debt support, and these are some good announcements and big announcements that will help people who are really struggling. The first one here, the Household Support Fund has been extended, and this has been around for a while now. And this is money that the government give to local councils and authorities to, at their discretion, give out money to people who are really, really, really struggling. This was due to end on the 31st of March. It's been extended by £500 million to fund another 6 months. Now, if you are someone who is really struggling, then you can find out from your local council how to apply for that. It will vary by council to council, but that's extended again, so for another 6 months. Budgeting loans, and this is something that if you're on universal credit, you are sometimes able to take out this advance payment. Is interest-free loan that you'll be getting, and you would pay it back out of your universal credit payments over 12 months. From December 2024, any new budgeting loans that are taken out, they'll have 24 months to pay this back. Now, this might seem a bit weird why you would give him more time to pay back, but remember, this is interest-free. So that same amount of money, now that monthly repayment will be split in 2, it'd be halved. So there's less pressure on the immediate budgets to cover this. Now, obviously, if there are ongoing problems, bigger problems in terms of affording things, that won't help because you're still going to be struggling. But at least it gives people in that situation, I guess, more time to pay back that money. And similarly to here now, for people who are really struggling, England, Wales and Northern Ireland, this relates to. Scotland have already abolished this on their version of it. But if you finances are so bad that you have to apply for a debt relief order, which is effectively a less severe alternative to declaring bankruptcy, it depends on your situation what would be best for you, but there would be a £90 charge for this. Well, from April this year, that's going to be scrapped. So that was seen as maybe a barrier to some people going down this route. Well, that kind of is now withdrawn. Also, as part of this, you'll be able to use a debt relief order on debts of up to £50,000. Current level was only £30,000. So again, that might mean more people can go down that route rather than bankruptcy. And you'll also be able to keep cars of a value up to £4,000 rather than the current £2,000. So there you go. That was everything in the budget 2024. Again, not the kind of the real giveaway there. I can't imagine that many people will be changing how they vote based on that budget. But it's certainly something from April the 6th at least, you will be getting more in your pay packet than you are currently right now. But just remember that is at the same time as many people over the coming years will be pushed into higher tax brackets. So the actual money you get back, you won't be seeing it, but it won't be quite as big as you kind of imagine. My name's Andy Webb. This is Be Clever with Your Cash. Thank you so much for watching. Until the next video comes along, check out these ones to make the most from your money.